And now, let us continue to go to work as we look at two more critical topics that will give us P.A.I.D. We're going to look at how to pick out the best real estate investment trust. We're going to give you a particular procedure that you should adhere to that will get you P.A.I.D. from picking intelligently in the realm of real estate investment trust. And then we're going to give you two positions that will get you P.A.I.D. globally from the technology boom. Now, many people are a little bit leery about real estate investment trust. Okay, we're talking about REITs. Some think they know what they're doing, but many do not. And therefore, they suffer with regards to losses because they're getting into a realm that you need to know exactly what you're doing. And if you do, your profits will soar. Now, I've spoken a lot to traders and investors who are still a little bit antsy of real estate after the housing bubble burst in 2008, and that's understandable. These particular people have a lot of cash on the sidelines, and they're desperate for income, but they're too afraid to jump into the real estate market. Usually when investors express these fears, what I do is explain to them the clever, the intelligent way, the way that the uber wealthy are investing in real estate, and that's through real estate investment trust. Now, when you look at the S&P 500 and its indexed ETF, which is SPY, one of our Mag 7/15 positions, and you look at the Spider Dow Jones REIT ETF, the Spider Dow Jones REIT ETF, which is symbol RWR. RWR only holds real estate investment trusts or real estate REITs, which are companies that rent out real estate and pass most of the rental income to shareholders as dividends. So, RWR is an excellent macro position for our Asset Wealth holding strategy. Let me continue. RWR outperformed SPY both before and after the financial crisis. Now just think about that for a minute, beloved, and listeners alike. Real estate beat stocks even during an economic crisis that was all about, right? You guessed it, real estate? You might be wondering, wait a minute, how's that possible? Especially if you know someone who lost their shirt during the last economic crisis, which was spurred and begun by the implosion of the real estate bubble. Many Americans lost their life savings and even their homes to the Great Recession. Others who barely survived the crash end up owing more on their homes than those houses are worth. So why didn't this happen to real estate investment trust? I can answer that in one word: management. You see, it's a dirty word nowadays since we're in a bull market and passive investing is all the rage. But in reality, active management, intelligent active management tends to outperform the dumb money when it comes to almost all asset classes. And this is doubly true for real estate. In short, real estate investment trusts survived the crash better than your house flipping neighbor because they are run by intelligent professionals who make careful and strategic investments in real estate. Now that alone is why real estate investment trusts are a great place to keep our money and get us P.A.I.D. But there's another good reason. In fact, two. One, real estate investment trusts allow us to have instant liquidity. We don't have to worry about putting a house on the market and hoping it sells or having a house rented out and hope the people keep their jobs so they can pay their rent. No. Real estate investment trusts allow us to have instant liquidity. You can sell it on any day that the markets are open and get your money. You can also put a trailer stop up under your real estate investment trust and you can protect your downside. You can always make sure that you're in control of your risk versus your exposure in the real estate arena. The uber wealthy do this all the time, beloved. You must understand and understand that, okay? He is a fool who goes out and tries to buy a house and hopefully he can flip it. when you can go ahead and get a real estate investment trust? Think about this. You go out, and most people who flip houses, they go out and borrow the money and then hope to flip the house and create arbitrage off the loan that they borrowed to buy the house and make a little profit. But I say to you, okay, why would you want to do that? When you can go out and if you want to borrow some money and put it in a real estate investment trust. And then set a trailing stop up under it. Let me give you an example. Say you borrow $100,000 to buy a house. Now from day one, listen to me, you owe $100,000 plus the interest. You in debt. Now you would say, well, no, I got the house. Well, wait a minute. You only have the value that you could sell that house for to offset the $100,000. If for whatever reason you can't sell the house for but for $70,000, guess what? You $30,000 in the hole on that $100,000 debt that you borrowed. But let me tell you the intelligent way. If you just got to borrow money, all right, wouldn't it make sense to go out and borrow $100,000? Put it in a real estate investment trust. Run a 10% trailing stop on it. And if the real estate investment trust falls to $90,000, guess what? It will sell. So your risk is $10,000. In the worst case scenario, you take the $90,000 out the real estate investment trust, you pay it back to the lender, and then you only have to come up with $10,000. Versus, you go out and borrow $100,000. And for whatever reason, that house doesn't sell at all, or it sells at a discount, $50,000, $70,000. Now guess what? You have to pay the differential plus the interest to the bank on the $100,000 loan. And not to mention, when you buy a house, okay, or you go out and get a loan for a house because you're not buying it. I hate when people say, I bought this house. If you got a mortgage on the house, you got a loan on it, you ain't bought nothing. You are doing an impromptu form of renting the house until you sell it. You're renting the house from the bank or the mortgage company. So let's get that straight. Now let me go a step further. If you go out and you say you just got to borrow $100,000, all right, and you borrow it and buy and finance a house, okay? At that point in time, you don't know what your downside is going to be. You hoping, and hope is not a trading and investing strategy, that the property value will go up and you can sell it for a property, for a profit. But don't you know any savvy buyer of a home, he's going to go back and check the public record and see what you bought it for. So why would he allow you to make a profit on the property on his back? Why would he not go downtown, or now you can go online, check the tax digest, see that the house sold for $100,000 to you, and then 6 months later you trying to sell it for $210,000 or $180,000. So he's going to sit there and say, wait a minute, why would I let that person make that kind of profit off my back? I'm not going to go ahead and do that. Now say you make some improvements in the property, okay? If he's a savvy a buyer, he's going to calculate the cost of those improvements and come back at you and say, look, this is what I'm going to offer. Now, the longer you hold that property and that mortgage is due, okay, then your bargaining power decreases. Because you can't afford to have that mortgage, and most people have another mortgage on their principal residence, and they got the other bills to pay. Now you're behind the 8 ball. So when you do that, you cannot. So when you think conventionally about investing in real estate, and that's why we say in Wealth Institute, we don't think conventionally. Unconventional people become wealthy. Unconventional thinkers. So when you go and get a conventional loan to go ahead and finance a house, so hopefully you can flip it because you're thinking conventionally, all right? You don't have any control of your downside, your risk. Because based upon other market conditions, that's what determines what the value of that house will be. Think back to the 2008 real estate bubble crisis. And unless you turn around and find somebody who wants to buy the house and that's stupid enough to go ahead and pay your price and allow you to make money off of their backs, you're not going to sell that house for what you think you have to sell it. You want to sell it for to get the profit you want. And the bank wants their money on time. So the intelligent way would be real estate investment trust, like I'm going over with you, where you can from day one control the amount of exposure and the risk that you have in a position. Risk and exposure should never be the same. Risk should always be less than your exposure. So if you go out and borrow $100,000 and you take that $100,000 and park it in a real estate investment trust, then you mitigate your risk to only 10%. Okay? When that $100,000 real estate trust, if by chance it doesn't go up and it falls to $90, then it would automatically sell. So now, when you go to sleep at night, you know, and the question is, can I afford to lose $10,000? Versus if you're doing it the conventional way, the question then becomes, can I afford to lose $100,000 or $50,000 or however low the house falls before some knucklehead comes by it? Do you see the analogy? That's why you've got to pay attention to what I'm about to tell you about real estate investment trust, so you will follow these 3 rules that I'm going to give you that will allow you to pick out the creme de la creme of real estate investment trust. Everybody, not somebody listening to my voice, everybody needs to pay attention. Okay? I don't need you to hear me. I need you to listen to me. There's 2 different things now. Listen to me. All right? Now, how do you go about choosing the big yielding real estate investments trust to get P.A.I.D like the uber wealthy? Well, really, it's really actually pretty easy. Let me explain to you how it's done. Number 1, you look at something called FFO. Write that down. FFO. Now, the first step is the easiest, but it's something a lot of people don't know how to do. That's why we're here at the Wealth Institute, to show you how to do it. You need to look at what is called FFO. Now, FFO stands for Funds from Operations. Funds from Operations. Now, it's a relatively obscure metric that real estate investment trusts use instead of the more familiar earnings per share, or EPS, used by most stocks. In addition, real estate investment trusts tend to adjust FFO, talking about that funds from operations, for depreciation and other expenses, meaning they usually report something called AFFO. AFFO. But a lot of analysts, including yours truly, casually refer to them as simply FFO. Now, real estate investment trusts will announce their FFO, funds from operations, quarterly. So you can easily keep track by following their earnings announcements. Now, there are 2 things you can do with this number, with this FFO number. When you look at the last 4 quarters of the FFO, you can compare it to a REIT's annual dividend payouts to get its dividend coverage ratio. This then tells you how sustainable the REIT's income truly is. Let me give you an example. For example, Realty Income Corporation, also known as the monthly dividend company, okay, and in the spirit of disclosure, I have some Realty Income Corporation positions. Now, Realty Income Corporation trades under the symbol O. It reported FFO of 0.77 cents a share in the 3rd quarter of 2017, which was preceded by 0.76 in Q2, 0.76 in Q1, and 0.75 in Q4 of 2016. Now, you add those up, and we've got FFO of $3.04. Now, since Realty Income pays out $2.54 a share in dividends per year, its dividend coverage ratio is 119.7. It's simply, let me give you the equation, $3.04 divided by $2.54 equal 119.68. This tells us that the REIT is earning more in rental income than it's paying out in dividends. Therefore, the dividend is safe. Booyah! Go back and listen to this. This radio broadcast, like all of our broadcasts, will be available on demand on our website at www.askthewiz.info. That's www.askthewiz upon completion of this live radio broadcast. Listen to it. If you can't write down notes now, then write down notes when you listen to it on demand And you just learned of the principal way of determining the best real estate investment trust that will get you paid and also pay you a dividend. And on the ones that pay dividends, you implement our dividend option trifecta effect strategy. Call option on the shareholder record date run up, put option on the dividend payout, and then the ER may be call or put based upon your ASK THE WIZ drill down. Rule number 2. Look at the portfolio of the real estate investment trust. All right, let's break this down. You see, the other neat thing about real estate investments trust is that they're easy to understand since they make their money buying and leasing real estate. Just knowing the kind of real estate they own and where that real estate is can tell us a lot about the trust income and growth potential. Again, almost all real estate investments trusts publish this information proudly on their websites. So you, me, we, the ASK THE WIZ family and listeners alike, we can easily look up Realty Income Corp, the example I gave you earlier, and learn that it has over 5,000 commercial properties in 49 states, and its buildings have a 98.3% occupancy rate. Realty Income even breaks down its top 20 tenants and how many properties those tenants are renting. For instance, I got this off their website. You can do the same thing. The largest tenants of Realty Income, based on percentage of total portfolio analyzed rental income, as of September the 30th, 2017, include the following. Let me go over the big guns that Realty Income rents and leases to. Walgreens rents 203 of Realty Income's properties. FedEx, 43 Realty Income properties. LA Fitness, 53 Realty Income properties. Dollar General, 525 Realty Income properties. Dollar Tree and Family Dollar, 456 Realty Income properties. AMC Theaters, 31 Realty Income properties. Circle K, 298 Realty Income properties. Walmart and Sam's Clubs, 40 Realty Income properties. BJ's Wholesale Clubs, 15 Realty Income properties. Treasury Wine Estates, 17 Realty Income properties. CVS Pharmacies, 70 Realty Income properties. Super America, 134 Realty Income properties. GPM Investments, 216 Realty Income properties. Regal Cinemas, 22 Realty Income properties. Rite Aid, 60. That is vital. That is key. These are the two factors that will predict future cash flow and stock price, beloved. And in the case of Realty Income, the portfolio looks pretty safe indeed, doesn't it? Now, Realty Income has focused on the best quality retailers out there to ensure its tenants aren't losing out to companies like Amazon. And so far, that strategy has been working. Number 3 thing you want to do to make sure you get paid from real estate intelligently, utilizing real estate investment trust, is making sure that you look at the price. You look at the price. You see, the final step is something a lot of real estate investors overlook. Now, I've already shown you the importance of FFO when it comes to the dividend, but the metric is more but this particular metric that I'm about to give you is important for one other reason. Okay, and FFO is important for one other reason. Let me tell you why. You see, real estate investment trust investors will often pile into one reliable dividend payer all at once, quickly making that real estate investment trust way overvalued relative to its income stream. Now, when this happens, a price drop usually isn't far off. This is exactly what occurred a year ago when Realty Income, after staying in a tight range between 15 and 20, the price to FFO climbed to nearly 25 right before the stock took a 25% dive in the middle of 2016. You see, family members, the bottom line is this. By carefully looking not only at how much FFO a real estate investment trust is producing, but also at how much you're paying for a piece of that FFO, you can save yourself from a big price drop like the one Realty Income suffered last year. Now that Realty Income is at a more respectable valuation, it looks like a decent position to get its P.A.I.D. Okay? But it, like all other real estate investment trusts, it demands that we complete these 3 rules, these 3 steps, these 3 analytics. Look at the price. Then you want to look at the portfolio holdings. Who are they renting and leasing to? And look at the FFO. You do those 3 things with regards to real estate investment trust, and you will get P.A.I.D. consistent.